Hello everyone, welcome to FISC Financial Strategy Consultants. Today we are going to discuss about reading number 30 of CFA level 3 Tax Planning LOS 3, where we are going to study what is core capital, what is excess capital, and how we calculate core capital based on mortality table, how we use Monte Carlo analysis to calculate core capital. So first, if you can see in the exhibit 1, in the left side of the slide, you can see a hypothetical balance sheet, and here you can see there are various kind of investments and house property and all, which are some sort of financial capital a person can have. And then there is other portion which is called net employment capital. So net employment capital is generally the human capital, or I would say the total present value of all the income he is expected to have in the future, whether it is through salaries, through pension, or through any other source of income. All those income, the present value of those are called net employment capital. Net employment capital or human capital plus the financial capital is the total assets which a person has. In the liability side, you can see that there are mortgages, there are current lifestyle, there are retirement expenses. All these are the liabilities which he has. So to fulfill this liability, you need some amount. These are also present value of all these expenses which you are going to incur in the future. So present value of all these will be your liabilities, and the same amount to fulfill all your liabilities is called core capital. That means the amount required to fulfill your expenses in the future till your death, and the rest of the amount which is remaining from which is the difference between core capital and the total assets you have, is called the excess capital. So it is very important for us to understand what could be your core capital to decide how you are going to live your life and how much capital you are required. As you can see that we have calculated some probabilistic number, like the present value of all the assets, all the income which we are going to incur, and present value of all the expenses. So the idea is that core capital and all the assets are a probability. It is not a definite number. It has some kind of probabilistic sense. Now what we are doing is we are forecasting and discounting. That means if your spending needs are forecasted in nominal numbers, you should use nominal rate. If it is forecasted in real numbers, you should use real discount rate. So this is a very important fact which you have to understand. This will help us a lot, because there could be a question where they can give real rate as well as nominal rate, and then you would get confused that which discount rate to use. So you have to remember this. So the spending needs is based on expectancy. It is not definite. As I said, it is having a probabilistic sense. So that's why we need to calculate survival probability. So to come to a present value, we have to define a survival probability till a particular age, and then we have to multiply that particular age with the spending of that particular year, and then we have to discount it. So you can see here, now there is a case when husband and wife both are dependent on same assets, same income, and that's why we have to calculate the probability of survival of both of them, a combined probability or a joint probability. And for joint probability, we will use the formula which I believe you have studied in your mathematics class, so as also, which is A intersection B kind of formula, probability of A intersection probability of B, and you can see the formula here. Now, so how we calculate it based on probability mortality table? You can see here that there are two people, Ernest and Webster, both age 79 and 68 respectively, and they have these probability of survival, and then we have calculated combined probability of survival of both of them. And then we have also the annual spending, which is calculated according to inflation of the years, and then we have discounted all this. So this is the discounted value. Now it's up to you, like till what age you want to calculate core capital. So if you want it for the next 10 years, then you have to add all the discounted value till 10 years, and then that will be the amount of core capital. If you want to calculate it for 15 years, 20 years, then you have to add all the discounted value till those years. So now as we have seen that it's a probabilistic number, and the discount rate is a very important factor here. So the discount rate is generally written required from capital markets. It could be a cost of equity, or it could be a WACC or anything, but that is something like a number which is not definite for all years, and that's why there could be a risk that we have taken a wrong number. That's why it would be better if you have some safety reserves apart from the core capital, so that you won't have been out of money till your death because of these calculations. So that is a very important thing which you have to understand. Now there are some example. There is an example in the CFA curriculum which we have used here. So there are two people, Alicia and Kenroy, living in South Africa and aged 64 and 61-year old. So now their annual spending is 1000 rand. Inflation is 3% and nominal risk free rate is 5%. Okay, so inflation is adjusted basis, their spending is 1000. Okay, and that's why we have to understand which rate we have to use, 2% or 5%. So here you have seen inflation adjusted basis, that means it is a real spending, and that's why we will use a real rate. Okay, so the question here is, what is the probability that either of them will survive? So we have to find joint probability, that will be found using this formula, and we have been given the individual probability of both of them. So using this formula you can find it. You will be able to see that this is the answer which is coming for you also. Now we have to find the core capital. So core capital will be annual spending which is inflation adjusted, so 1 million for each year. Multiplying it with the probability of survival will give us expected spending, and then discounting it with the discount rate will give us the discounted value, which will be 2,882,000. This is the example which you can see in the CFA curriculum as well. Now we will move on to the Monte Carlo simulation. So it is a kind of simulation which gives us a number of results, like say 10,000 trials based on certain inputs and assumptions which we have modeled in our simulation. So this is more like an Excel kind of tool which we require to create this kind of model. We will have to put the inputs and like the assets we have and all, and then we have to provide some assumptions like the distribution amounts each year which is required every year for matching their expenses, then the irregular one-time distribution which they are expecting, like daughter's marriage, their son's marriage, college fee of children's, or anything else like any accident which may incur to the renovation of house, this kind of things. Then inflation, asset class returns, correlations, all these they can calculate, and then they have to specify a probability thing like a confidence interval which is generally 5%, and then they get a number which will be the core capital of their portfolio. So if the portfolio manager thinks that this number is correct, they can go with that, else they can change their inputs to get a more realistic number for them. So that is one format of display. In the other format they also get a probability of ruin, which tells them like what is the probability that their portfolio will reach zero even before their death, based on the retirement age they are going to have and the amount of spending they are going to have each year. That means the amount of distribution from their total asset base. So here you can see in the table we have been given a retirement age, we have been given median age at death, a percentage of total we have in the initial period. So if we have $100, so $2 we are spending in each year, $3 we are spending in each year. So this 100 is that basically the amount which we are going to have on the day of retirement. So if we are going to have a retirement age 55, our expectation is 83 median age death, and the spending we are going to have is 3% per annum, then there is a chance that 6.3% probability is there that our portfolio will reach out zero even before we are dead. So that's a probability of ruin, which is another way to understand Monte Carlo simulation result. But I would urge you to focus more on mortality tables and those kind of calculations, because those are more often to come. You won't be able to see any calculation in the Monte Carlo simulation because that requires computerized model. They can ask you in the probability ruin probability table. They can ask some other factors about Monte Carlo, but more calculation part would be in the mortality tables, and there could be something on the definition of core and excess capitals. So this is what you have to understand in this LOS. Do watch our previous LOS if you haven't, and wait for the next ones, and please like, share and subscribe this video, and let me know in the comment how you feel about this video. Thank you very much.